The next approach toward computing GDP is what's called the income approach. And as we, in the last video, noted that the expenditures approach is one way of computing GDP by looking at who's doing the buying. In other words, who's generating demand for the output, which then becomes the income. And so, as I noted in the last video, the terms GDP, output, and income are used interchangeably, as is the algebraic symbol Y, which we oftentimes use as a shorthand for GDP, particularly when we get into the graphs and models. It's just an easier way of looking at this. So on the supply side, what are we really talking about when we say supply side? Well, we're talking about business firms, obviously, which is a big driver of this, but also households, because households generate output, that is their labor, and as a result, they're compensated by income. And so as a result, we're all on the supply side, whether we have a business or not. Even if we go to work, we're still on the supply side, and we're providing our labor resource to generate income, and we're compensated in the form of income. And also government is compensated here in this list. And by the way, if you're looking on the GDP accounting data on the BEA website, you'll note that I've sort of cut out some things, and I've even cut some things out that were noted in your text, because obviously I've got some limitations as to what I can include here. But I did want to include the highlights, and in particular be able to provide a bit of commentary as to what these are. Okay, so first let's talk about GDP as the starting basis. Ideally, GDP is computed under the expenditures approach, should equal GDP under the income approach. We'll see how that's problematic from a couple of different reasons. But starting with this, we must know that we produce GDP in a particular year. Remember, it's an annual value. It's reported quarterly, but it's an annual value. And as soon as we create some fixed capital goods, machines, equipment, office buildings, they're immediately beginning to depreciate. I think most of us are familiar with the term depreciation. If you buy a new car, the second you drive it off the lot, it's already begun to depreciate. That's the similar thing that's going on in the economy. Some of the stuff that we're producing of a fixed nature is already depreciating, and so we have to take the net value. And it's not a huge difference between gross domestic product and net domestic product, but it is worth noting that we are trying to capture the wearing out of things which have already been produced. And then we have what's called the statistical discrepancy, which could be up positive or negative. I probably should actually represent this as positive or negative, rather than simply negative. And by the way, the parentheses, or sometimes you might see these as brackets, represent negative values. And so whenever you see these, and I know in accounting data you'll often see parentheses as representing negatives. You also might see brackets as well. Well, in this case, statistical discrepancy could be either positive or negative, because here's the thing. We would love to be able to say that the expenditures approach computation is exactly going to equal to the dollar, the income approach, but we're talking about an economy approaching $20 trillion in output. Not quite yet, but 20 with 12 zeros. It's a large feat, and there are a lot of things that we don't account for that accurately. So we have a number. Now, fortunately, this is not all that large. And what that means is it's less than 1%. It's usually less than 0.5% in terms of statistical discrepancy. And I think this number is actually going down over the time as we get better at computing these. There are errors in reporting income, particularly one of the ways that we arrive at some of this is through tax return data, and sometimes tax return data is wrong or it's restated, and so as a result this contributes to a statistical error that has to be corrected so that GDP here in the income approach equals GDP in the expenditures approach, because they should equal. It's the same value. Okay, and then plus or minus net foreign factor income. What is net foreign factor income? Well, first of all, it's important to know when we talk about factors, including in particular labor factors, that is the value of output produced abroad, even if it's by an American citizen, doesn't count in our GDP. So for instance, if you're a worker who has spent some time in Germany, for instance, doing work, the wages that you earn in Germany go into the German economy, not here, even though you may report that income as US-based income, because US nationals report income on their entire worldwide income. As economists, we need to take that out because it didn't happen here. We're talking about gross domestic product. That output and that income belongs to Germany, not here. Likewise, somebody who's here from another country, a guest worker or say an exchange student who does work here, may not pay that much tax in America on it, may report it back in his or her home country, But we report it here in our country because it happened here, and we don't care what the nationality is of any of the workers. And so that differs from something that we used to call gross national product. I guess we still use it, but we don't use it as much. That would not include this. Gross national product would be the output and income of all Americans everywhere. And we're more concerned with what goes on here for reasons that are related to policy and what to do about things like fluctuations in GDP. Okay? Taking those out or adding those in, we get national income, which can often be thought of as being in fact, we use the term national income oftentimes as sort of a proxy for GDP. And that is, we're really talking primarily about business income, is really what we're talking about. And we oftentimes sort of may even refer to this as corporate income, even though for those of you who've taken business courses before, you might know that corporations are not the only kind of business in terms of the form of the business. There are partnerships and proprietorships, but nonetheless, they are dominated by, output is dominated by corporations. So as a result, national income could be thought of as that, okay? Okay, so moving down, what we're doing is we're sort of moving away from the big macroeconomy, and we're getting down to corporations, and we're accounting for their income. We're even accounting for how government is compensated. Not that government sells output, but it does provide output, and we fund government through taxes. And so government is a provider, and it is compensated somewhat. It's not a perfect one-on-one model to view corporations and government as the same. There are numerous differences. All we're really trying to get at here is to try to compensate all three actors in the circular flow model: households, firms, which are dominated by corporations, and governments. Okay? So, we're talking about business income primarily here, so we have to take out of that Social Security taxes, and that would also include Medicare taxes. It would probably also, I believe, include unemployment taxes paid by businesses. Why are those taken out? It's a big figure, actually. Social Security taxes are jointly split between employer and employee, and together they're equal to around 12.5% of total payroll. So it's a pretty big percentage. If you think of payroll expense, labor expense, as being one of the major expenses of businesses, this value is not insignificant at all. It's a big one. We also take out corporate income taxes because we needed to remove some of those values. Okay, corporate income taxes are a takeaway from national income, take away from corporate income in particular. And we are working our way down in the household. And then undistributed corporate profits. Businesses earn income, but don't distribute those. Distribute those to whom? Ultimately to households. They don't work their way down to households. We know that there are a lot of companies that earn profit and never distribute them back to their owners, the shareholders, and as a result they don't work their way into household income, what we call personal income. So as a result, we cannot include those in the value that is working our way down to this. And then finally in this category are plus transfers. This is always a plus, and your text has a excellent discussion about what transfer payments are. Transfers are included in here, and they would not be included in the circular flow necessarily. They're not included in the expenditures approach because no one is really demanding these. What they simply are is this. These are one-way movements of money from government to households. There are corporate transfers, but we're not concerned with those. We're concerned here about one-way movements of money from government to households. And notably what we're talking about are things like Social Security, unemployment benefits, all kinds of welfare benefits like food assistance, housing assistance, tuition assistance, student aid. It's a pretty long list. So we have to include it because there's no transaction that happens. To receive a transfer, you don't really have to do anything, you just have to be eligible. And I realize that when I say you don't have to do anything to be eligible for Social Security, obviously you have to work for around 10 years, probably minimum, in order to eventually qualify for it. So it's not like you don't do anything, it's just that there's no quid pro quo because you could work for 20 years, have no spouse or dependents, and no one ever having received a transfer. So as a result, transfer is the other side of the tax that flows to you if you're eligible. There's no transaction, you don't have to work for it. To get that, you just have to be eligible for it. Realizing, of course, the caveat that you do have to work in order to be eligible for Social Security, but not for a lot of others, like Medicare, Medicaid, other kinds of things. So transfers get added in, also that we can work our way down to household income, which we call personal income. Personal income is an important value. It's actually a fairly large percentage of GDP. And I want to reiterate something that I talked about in the prior video, that I think a lot of people have the idea that the economy is dominated by either big business or big government. And in fact, the majority, around 3/4, I think, of GDP is composed of personal income. That percentage varies, and so I wouldn't want to say, write this down and say this is always going to be the percentage, but it's a big value. And what does personal income include? Well, it includes things that we would know to be in that: wages, obviously, and wages and salaries. We usually use the term wages as being a catch-all for wages and salaries. It would also include things like commissions, which are somewhat different than wages and salaries. It would include things like bonuses that people earn. It would include things like tips. It would include what we call passive income, in the sense of interest income, and interest income on savings on certain kinds of investments, dividend income on other kinds of investments that would pay those. It would also include things like rents and royalties. Rents, obviously, on things like real estate or anything that is rented to somebody else. We have to include in personal income because there's no other place that we're actually getting it, and it may be somewhat difficult to see it in the expenditures approach, so that would be counted there. And rents and royalties, and any other kind of income that flows to households. Okay, so that's personal income. And then the final category here is personal taxes, and these are personal income taxes. And in fact, there are some other categories that I've cut out up here only for purposes of brevity in this presentation and space. Things like sales taxes, real estate taxes, which go up further here. We're talking here about personal income taxes at the federal and, if applicable, at the state level. Not all states have a personal income tax. Texas, Washington, some others, Nevada do not. But where applicable, it would be a tax. And then we work our way into the final bottom line, and that is disposable income. Disposable income is simply defined as being the after-tax portion of GDP that is earned by households. After-tax portion of GDP earned by households. And then one final bit here before I wrap up this video is this. If we take disposable income and break it out into two components, we have already satisfied taxes, including things like income taxes and Social Security taxes, which are shared between both firms and businesses. There are really only two things that households can do with disposable income. That is, they can channel it into consumption back to the expenditures approach, or they can take it and they can generate savings. And I'll talk more about the savings relationship, in particular, the relationship between savings and disposable income, consumption of disposable income, and how these are complementary, because these are the only two things that can be done with households' disposable income. Even a charitable contribution would likely be considered to be consumption. And so we'll talk more about what savings is all about, because savings has got a unique role in the economy. It doesn't show up in the GDP accounts. The interest on it might show up down here, but it's not going to show up in terms of something that's actually being done. And in fact, we might know just off the top here that savings is occasionally problematic, particularly if consumption suffers and overall demand suffers as a result of excessive savings. And that's a discussion that we're going to be getting into in subsequent videos. And I hope that if you have any questions regarding either of these approaches to computing GDP, that you'll feel free to contact me.